Hi friends, welcome to the Shikhar series of BFM. In Shikhar series, as you know, we are covering all the subjects of CAIIB. Today I will be covering BFM Treasury Risk Management Module C. In this series, we are covering the objective questions, numericals, wherever they are, theory, everything is covered. So follow the series till the end. Share it with your friends. Like this video. Okay? Subscribe to the channel, English channel. Okay? Don't miss it. So let's start without wasting the time. Okay? First question. Which is the most important risk management functions in the banking treasury? So which is the most important risk management function? Now note this. We are requiring risk management function in basically treasury. Banking treasury means treasury only. Okay. So which one is the most important part? Here, always remember, treasury of any bank, the main job of treasury is always to measure or monitor short-term liquidity. Main, very important job. Somebody might argue that short-term, long-term is also required. It is required. Who says no? Long-term liquidity is also required. But main job, if you ask me 80-20 principle, 80% of the job is short-term liquidity. Okay? Short-term means in the sense it can go up to 6 months. RBI is very particular about 28 days. Okay? So this can go up to 6 months. Got it? So what is the main job of under risk management for the treasury? So balance sheet management, market risk management, policy management and asset liability management. Think over it. Now as the topic is risk management, treasury risk, many of you might have first made it in your mind. Risk, this will be the answer. Risk management. Think. What did I say? Important part. Under risk management, what is the main job of any treasury? Not only banking here. This treasury part is common to banking also, to private companies also. Everyone it is common. Because treasury means what? Your investments, where you need to invest. How you will purchase the bonds. How you will manage the forex. That is all. So, balance sheet management. Is it balance sheet management the main job? Balance sheet management is not only related or not only the job of treasury, but balance sheet means what? Your assets and liabilities. What are the main assets and liabilities of any bank? Is treasury the main asset and liability? No. Treasury is a secondary part. Main job of yours in banking is loans and deposits. That's why we are here, right? We are in bank for assets and liabilities, loans and deposits, isn't it? So, balance sheet management is not the main job in treasury. In banking it is there, but in treasury not the one. Out. Market risk management. Market risk management for treasury. Is it so? Yes, that can be the answer. So, market risk management, that is one answer. But in fact, I would suggest policy management. Policy is the job of your board of directors, BOD, board of directors. We are preparing the policy and seeing to it that the policy is percolated throughout the bank. That is the job of the BODs. Asset liability management, ALM. Now the real fight in this question is between these two, market risk and asset liability. Okay. So in exam, whenever you get such options, the best answer over here is ALM, asset liability management. Because market risk management is not only related to treasury, it is related to others also. Okay, to your loans, but specifically for treasury, asset liability. But if you get this option, if you are having an option in which it says that E, B and D, then the option will be E. Actually, if you ask me correctly, the answer is B and D, both. Because market risk is also to be managed by the treasury. Market risk is a short-term risk. Market risk never goes on for long. It's a short-term risk. Okay. So market risk management and asset liability, both are the answers. But in exam, if you have these 4 options only, tick on ALM. Okay, asset liability management. Next one. Got it, everyone? Given the diversity of the balance sheet profile, the design of the risk management functions should be, so diversity of the balance sheet profile. What do you mean by diversity of balance sheet profile? Diversity means I'm having my income from various sources. Okay, what are my assets in the balance sheet? Assets. My assets are my loans, then my bonds invested, or you can call it investments. My loans and my investments for any bank. Okay, loans and my investments. Loans are majorly the part of your retail and corporate. Even treasury gives loans. That is a separate part, but mainly the job is of this, right? So loans and second is investment. So diverse profile means what? Diversity. I'm having this. Similarly, in case of liabilities, this is for assets. For liabilities, what is the case? For liabilities, I have deposits, and my loans which I have taken, loans which the bank takes. So diverse, huge diverse. And here also in these we have so many types of products. Interbank borrowings, that is separate. Forex borrowings, that is separate. So that's why it said diversity. So diversity of balance sheet profile, the design of risk management function should be. So this risk management function should have what? Bank specific, dictated by the size, complexity of the functions. Bank specific means what are the requirements of my bank? Requirements of my bank. Okay. Level of technical expertise. What is the expertise means? How much trained my staff is in this angle. My staff may be trained usually in loans. The staff may be trained in deposits, but here, this part, treasury. Okay. What is level of expertise for my staff? Is my staff able to take big deals? Is my staff able to take the complex deals? Complex means it involves 3 to 4 currencies simultaneously. Is my staff able to do that? Is my staff able to take the derivatives, swaps, okay, FRAs? That is known as the technical expertise. And quality of MIS. Quality of MIS means what? How fast the communication flows. Here, MIS, main job of MIS is what? Communication. How fast the communication flows. How fast the communication flows. Okay? Quality of MIS. Got it? So what is the basic design of this risk management? Is it ABC or is it all of the above? Let me see in the comment section. Is it ABC or is it all of the above? It is all of the above, right? It is all of the above. Got it, everyone? Next. Okay, so next one. Which of the following do not form the part of risk management organization? Now look at this. Do not form. Okay, do not form. Always in the exam you need to focus what is asked. Do form or do not form. That is what is to be checked. Do not form the part of risk management organization. So shareholders, board of directors, senior level executives and support group. Who do not form the part of risk management organization means framework. Organization means framework. So who all are not the part? Okay, firstly understand the risk management framework. What is the risk management framework? Under risk management framework in any bank, first at the top is board of directors. Board of directors. Everyone pay attention to this. Very important one. Board of directors. Below board of directors, there is RMCB, Risk Management. I'll write this full form, Risk Management Committee to board. This is known as full form, to board. This is the full form of RMCB. This is called as RMCB. Okay. This is a committee of risk management to board, reporting to board. That's important, reporting to board. Okay. So RMCB, below this RMCB, there are three subcommittees. Okay, there are three subcommittees. Which are those? CRMC. CRMC means Credit Risk Management Committee. I'll just write a short form for credit now. Remaining part is same. RMC, Risk Management Committee. So credit. Second is ORMC, Operations Risk Management Committee. Operations. And third one is Market Risk, but that is not called as MRMC, Market Risk Management. That's called as ALCO. ALCO. So this measures market risk. This measures the market risk. Okay. So now look at the question. What is important over here? Who all are the stakeholders? Board of directors, they are there. Senior level executives, they are there. Support group, it is here. There is a support group over here. Below these, there is something called a support group. Means other employees who will support these committees. So all the three are there. But who is not there? Shareholder. How is the shareholder involved in this? Shareholder is just an investor. Shareholder requires the returns. Okay. That's the basic logic. So who is not the part? That is shareholders. For that, kindly remember this framework. This framework, you'll definitely get 2 marks on this framework, somewhere or the other. Board of Directors, RMCB, then 3 committees, CRMC, ORMC and ALCO, and below them there is support group. Very important terms. Huh? Don't miss this at all. Next. Dash of Treasury monitors exposure and stop loss limits. Dash of Treasury monitors exposure and stop loss limits. Who will look at this? Firstly, what are the offices in Treasury? In Treasury, there are 3 offices. Front office, back office, mid office. These are the 3 offices in any Treasury. Front, mid and back. Okay. The employees in the front office are called as dealers generally. Dealers. Okay. These employees are the ones who actually deal with the clients. They deal with the rates, the rates and everything is given to them, but they directly speak to the client. Negotiate the dealings. That is called as dealer. Okay. So dealers, these are the employees. They have a huge salaries. Kindly note, if anyone wants to go in, means increase your salary, go in treasury or trade finance or corporate finance. Huge salaries. Okay. So coming back, these are called as dealers. Now these are the deal makers or even breakers. Makers. Let's not talk of breakers. Now, what does the back office do? Back office does the job of all your compliance, you can call it. Compliance in the sense reporting part. Reporting. So reporting is done by the back office. Okay. Plus, not only reporting, all your transactions are settled. The documentation of the transactions, all the transactions is done. Documentation is done by the back office. Okay. So what is the job of the mid office then? Mid office has a major role. That major role is compliance. Compliance with RBI norms, compliance with the prudential norms, compliance with the bank policies, everything over here. Even this stop loss limit and exposures, this is also given by the mid office. So your answer for this is mid office. Okay, mid office. This is the answer. Mid office is the main office because what is mid office? It's like the support group. It supports the front office. Suppose if the front office wants to make a deal with some client, for that it will need the rates. So those rates are provided by the mid office, the latest ones. It is like the support group. Okay. So mid office does all the job. Compliance part, giving the rates, then actual deals are dealt with by this mid office only. These are just the front runners. Okay, so got the answer everyone? Next one. The primary responsibility of understanding the risks run by the bank and ensuring that the risks are appropriately managed should be clearly vested with. So primary responsibility of understanding the risk, understanding first the risk run by the bank. What are the various risks in the bank? What are the various risks in the bank? You tell me. What are the various risks? As per the Basel norms, three main risks are which one? Credit, then market, operations. These are the three main. After that also there are many risks. Like for example, this reputational risk, reputation. Then second is business risk, or we call it strategic risk. Strategic risk. Okay. Strategic risk. Plus there can be many. Forex risk can be there, liquidity risk can be there, but these are mainly under these three only. It comes under market risk only. So now the question. The responsibility of understanding the risk run by the bank and ensuring that the risks are appropriately managed. Appropriately managed. How to manage the risk? Vest with whom? Should be clearly vested with whom? Is it CEO, board of directors, auditors, or shareholders? Think, very simple answer. Think over it, everyone. Let me see. Everyone think over it. Whom do you think is the main person responsible for the same? Think everyone. Is it board of directors? Yeah, the fight is between two only. One is the board of directors and second is CEO. Board of directors and CEO. The fight is between these two only. So what is the answer? The real answer for this will be board of directors. Very, very important. The following the risk, managing the risk of the bank should be done by the board of directors only, because they are the ones who actually focus on it and run the bank actually. Okay. Others are all paid employees. Board of directors are not paid employees. Kindly note. They are not the paid employees. Okay. Next one. Which among the following is a major difference between the OTC and exchange traded derivatives? Which among the following is a major difference between the OTC and the exchange traded derivatives? So which of them? Difference. Okay. Which of them is a major difference between the OTC and the exchange traded derivatives? What is the OTC? I think I have taken this topic once earlier. OTC means what? Over the counter. Over the counter means what? It is between the bank and the customer. Only two parties are there. OTC products, there are only two parties, buyer and seller. There are only two parties in OTC. Whereas in ETC, exchange traded derivatives or exchange traded products, okay, there are three parties. Buyer, I'll write short form now, buyer, seller and exchange. Exchange. Okay. So these are the three parties in ETC. So what is the major difference between them? OTC are cheaper as compared to the exchange traded derivatives. Means OTC are cheaper, ETC are costly. Is it so? You can say anything like this. Here, derivatives cost hardly depends on whether it's OTC or ETC. Derivatives cost depends on the risk involved. Risk. What is the risk? If the risk in ETC is higher, its cost will be higher. If the risk in OTC is higher, its cost will be higher. So this is out. OTC derivatives are mainly for customers, wherein exchange traded derivatives are for banks. You mean to say OTC are mainly by customers. So we are dealing with the customers only. It can't be with the banks. And ETC are for the banks. Means in ETC, customers can't deal. Only banks can deal. Is it so? Nothing. Anything is for anyone. OTC can be for the banks, ETC can be for the banks, anything. In fact, mainly the banks deal in OTC products, bank to bank. All your treasury transactions, they are mainly done by the banks between themselves on phone. And then they have inputted in that NDS. Okay? So this is the way. In OTC derivatives, counterparty risk is considered prominent. But in exchange traded derivatives, counterparty risk is absent. Think over this. I have crossed these two, but think over this. And last one is what? OTC derivatives are generally for hedging risk, wherein ETC are mainly used for speculation. Means ETC are for speculation. Exchange traded derivatives are for speculation. It's nothing like this. All the derivatives, let it be OTC, ETC, anything. All the derivatives are mainly for hedging. Hedging. Okay, all the derivatives are mainly for hedging. Kindly note this. Although nowadays you see many of the customers enter into that options market. बहुत पैसा है, बहुत पैसा है. I invested, you see the YouTube videos. I invested 5,000 rupees. Now I made 2 crores in 1 year. Saying that you also invest. And then 5,000 is also gone, everything is gone. Kindly note, derivatives are for hedging the risk. What do you mean by hedging the risk? Suppose if you have purchased some share for the longer term to cover the risk for the shorter term. Means suppose if I have purchased Reliance share for 2 years. Now I am afraid that in the near term this Reliance share might go down. For that I will buy the option, put option. That is known as hedging, covering my downside position. That's meant by hedging. Okay. So derivative products are mainly for hedging. Kindly note this. Clear? Now what about this? Counterparty risk is considered prominent. This is the main answer. This is what the main answer is. In OTC product, there are two parties, right? Buyer and seller. So any one of them can default. Tomorrow if the bank defaults then, or tomorrow if the buyer defaults then, customer defaults, anything can happen. You'll say, how can the bank default? Why not? Many banks have defaulted. Many banks. 2008 crisis, what was it? Lehman Brothers. Starting from long back, 1964, 74, Hearst Bank. Many banks have failed. So it's nothing like this, that this will happen, this will not happen. Forget it. So important part over here is buyer and seller. There's always a risk for buyer may default or seller may default. But in ETC products, the counterparty risk is absent, completely absent. Why? Because there is an exchange over here. What does this exchange do? Exchange will take over the risk. of buyer and seller. It will create a pool of money also, and pool of your this investment bonds also, so that no one defaults. Very important one. Okay, got it? So C is the answer. Next one. Internationally, a committee approach to risk management is being adopted. So risk management follows the committee approach. What is that? Just now I gave you that. Board of Directors, RMCB, CRMC, ORMC, ALCO. That is committee approach. So a committee approach of risk management is being adopted. Which committee deals with different types of market risk? Which committee deals with market risk? Is it ALCO? See here, this is called as actually ALCO, Asset Liability Committee. Some banks call it Management Committee. So basically this is ALCO. Second, Credit Policy Committee, Liquidity Policy Committee, Credit Liability Management Committee. Now you answer me. Which will look into the market risk? Yes. Which committee will look into the market risk? Is it Liquidity Policy Committee or Credit Policy? Some of you have answered Credit Policy. Credit Policy is not the one. Credit Policy Committee will look into CRMC, Credit Risk Management Committee. Okay. So this is out. There is no policy, no committee called as Liquidity Policy Committee. No committee. Liquidity is always managed by ALCO. Liquidity is always managed by ALCO. And what is this last one? Credit Liability Management Committee. Nothing. Okay. This is totally out. This is totally out. Somebody might argue, sir, we have some committee with this name in our bank. You can have 1,000 committees in your banks. I can have a canteen committee. What's the problem? I can have a canteen committee. What is in the risk management framework? That's important, isn't it? So the answer is this, ALCO. Got it? The responsibility of designing and implementing the ICAP, Internal Capital Adequacy Assessment process, lies with. So designing and implementing ICAP lies with whom? Board of Directors, ALCO, Asset Liability Committee of the bank, Risk Management Committee of the bank, Risk Management Department of RBI. Firstly, you tell me what is this ICAP? What is this ICAP? This ICAP has come from Pillar 2 of Basel 3. Pillar 2 of Basel 3. What are the three pillars of Basel? Everyone tell me. What are the three pillars of Basel? Chalo, let's write one by one. Okay. What are the three? Let's do this revision. What are the three pillars of Basel? Pillar 1 is what? Pillar 1, P1. Minimum capital requirement. Minimum capital, or we call it enhanced minimum capital. Minimum capital. This is Pillar 1. What is Pillar 2? SREP, Supervisory Review, SR. SRP also we call it. SRP or SREP, Supervisory Review and Evaluation Process, or some banks call it Supervisory Review Process. One and the same. Okay. Pillar 2. What is the third pillar? Market discipline. Okay. What is this? Now look at this. I'll give you some additional details over here. This answer is very easy. Okay. This answer you might have got it by now. See here, one thing always you remember. Anything in the bank, anything, any risk, rests with Only one party. Board of directors, because these are the persons who handle the bank. Just now we saw it in one of the questions. Now let me come to this point. As the question has come, let's discuss this. P1, minimum capital. Minimum capital requirement is generally of three types. Three parts: credit risk, ops risk, market risk. Okay. Now Basel III has added 4 ratios in that. Cook's ratio, CRAR, LCR, NSFR, leverage ratio. 4 ratios have been added in this. Pillar 1. Pillar 2, SREP. There ICAP has been added. ICAP means this one. Capital adequacy assessment, this framework. Okay. So this ICAP has been added. Now what is this ICAP? Kindly note few points. This pillar 1 is done by the bank. Each bank individually will do this pillar 1. This is generally done by RBI, auditor. RBI or auditor means RBI or anyone. Whoever does the audit. RBI does the audit, even the auditors do the audit. So RBI or auditor. And third one is, this is for the investor. Now this means, actually it means transparency, or we call it, another word to this is transparency, or the other word to this is corporate governance. Very important words these are. Corporate governance. These are the important words in banking nowadays. Transparency, corporate governance, market discipline means that every investor has a right to know whatever is happening in this pillar 1 and pillar 2. Every investor has a right to know. That's why this pillar 3 has been brought in. And this ICAP document is basically a challenge to the pillar 1. Everyone understand this? See here, every bank is having the ICAP document, its own ICAP document. And what does RBI do? RBI challenges that ICAP document. That your ICAP is having these loopholes. Kindly correct them. This is my standard documentation. This is your documentation. You are having these loopholes. Kindly get it corrected. Else you will face a problem someday. That's what RBI tells you. And that is the role of RBI under this second pillar. SREP. Got it? Clear, everyone? Internationally, a committee approach to risk management, done na? Just now we did it. Now before going, everyone kindly join the focus batch. Just now it has started. Just now, few days only. In fact, I have to start certain portion in this. So join this. BFM is yet to be started in this. ABM is just now started. One lecture has been done. So join it ASAP, focus batch. Numericals, objective questions, case studies, everything is covered. You can join this. Very important point. In Mumbai, we are having the bankers conference on 2nd March. Don't miss it. 2nd March, holiday, bank holiday is there. Andheri it is. Andheri. Okay. So we are having it in Andheri. The link is given on the channel also. In the below also, the link is given in the comment section. Mayor Hall, Andheri West. Waterford Building, All India Institute of Local Government Building, Andheri West, Mumbai. Don't miss this. There's a QR code over here. Scan this QR code also. Okay. And how to join the classes? See this. For joining the classes, you have to go to Adda 24/7. Always go through the app. In the app, you are getting 1% extra using the coin systems. Okay. Always go to Adda 24/7 through the app. Okay. Coin systems will give you 1% extra. Don't you want extra? You want it, na? So go through the app. Download the app. Okay. See this. Join this focus batch. This bonus batch. Okay. CAIIB. So join this bonus batch. Latest one. Okay. Join this ASAP. In fact, you can go below also. If you go below, you will see JIB and CAIIB. Click on CAIIB June 25. Look at this. The new focus batch. Just now it has started. Join it. Ebooks, mock tests, online live classes, recorded videos are available, best in class material, compatible with any of this Android or your anyone. Okay. Look at the discount part. Put the code Y432. Never forget this code Y432. Click on enter. Okay. Look at it. 80% discount you are getting. 80 plus 1% extra. 81% through the app. Download the app. Join it as app. You can join the Mahapack also. In Mahapack, you are getting 15 plus batches per subject. And right now you are getting double validity plus 81%. Okay, both the things are there. Double validity plus 81%. See this, join this Mahapack. How to join it? Look at this. CAIIB Mahapack 2.0. Look at this, 6 plus 6, double validity. Plus, you are getting 81% discount as it is applicable in the batches. So both, never forget this code Y432. Okay. So look at it, 80% discount plus double validity plus 1% extra. So don't miss it. Such opportunity is rare. Okay. Join us.